Hello everyone, welcome to the price action day trading cheat sheet. A couple people had asked me for basically a summary of the key things I look for when I'm looking at price action, when I'm day trading. So here they are. I'm going to run through the first page and then we'll go through some examples, then we'll go through another page, a couple examples. And so what I really look at is wave size. So I trade on a 1 minute chart. And I like to measure out how far the price moved before it had a pullback. And how big of a pullback, that'll be a little bit subjective. But basically, as long as the price is making upward progress, I consider that part of the wave. And then if we have a couple candles going the other direction, especially if they're a little bit bigger, that's when I'm going to consider the pullback. So I don't really enjoy holding through pullbacks per se, so I like to know how far the price is running before it has a pullback, and then that way I can establish my target. And as we'll discuss a little in the next point here, we can hold through pullbacks. There's nothing wrong with holding through pullbacks. It's just be aware of how far the price is moving, because a lot of people get into a trade. The price is, let's say, moving 10 pips or 10 cents at a time and then pulling back. And they set a target at 20 cents or 20 pips. And then they get freaked out when the price moves up 10 cents or 10 pips, starts pulling back, takes back most of the profit they had. They get scared, they get out. But really, that's what the price has been doing. If it's been moving up 10 cents and then pulling back, why should anything change once we get into that trade? So we accept the pullback, we hold through it, and then we calculate out, okay, the next wave is probably going to be 10 cents. Do I want to hold through another pullback, or do I want to move my target to where it's likely to get hit based on these wave sizes? So this really helps me out. It also psychologically kind of soothes you during a trade, because you have a rough estimate of how far the price is moving. So you also have a rough idea of how long that trade could take. If your target's within range of one pop, then you should be out within a couple minutes. But if you've set a target that may take 1 or 2 or 3 pushes, then you know you're going to be in that trade for 15 minutes. And since you have that in your head already, it's a little easier to accept as it unfolds. It doesn't mean that it's going to be entirely easy, and you might not have some stress during that 15 minutes if you have to hold it that long, but at least you know sort of the price path that's been occurring, how far the price typically moves before it pulls back, and then also you have some choices. You can decide if you want to get out on the next thrust depending on how far it moves, or hold for the bigger target, which means holding through those pullbacks. Stop loss size, this is another thing I look at, should be half of the upcoming estimated wave size if you're going to get out on the next wave. So like I said, if price waves are typically moving up about 10 pips and then pulling back, then your target should be within 10 pips of, the last pullback low. Otherwise, you're probably going to have to hold through another pullback. So how does that relate to the stop loss size? Well, if the price is moving up 10 pips, and we want to be a little conservative with that probably, so we want to maybe put our target at 8 pips or 8 cents, then what size should our stop loss be? I would say it should be half of that. That way you have at least a 2-to-1 reward to risk. So if the average price moving up 10 pips, 10 cents, and then pulling back, set your target at 8 cents once you have your trigger, and then your stop loss size should be 4 or less. And the market has to give us that. So I'm always waiting for a price trigger. I use a candle. Basically, as the price moves above a trigger candle, I call it, then I can enter the trade. But if that candle's huge, I don't want to have my stop loss right in the middle of that candle. I want my stop loss below. So again, we'll look at examples of this. And so I need that candle. So basically I need the price to tell me how much we're moving, and I need it to tell me here's a good place for a stop loss. And then if that aligns, I can take the trade. So as I talked about, you can always go for bigger targets, but just be aware. Look at the price action, how far are the price waves moving, and if you're going to have to hold through pullbacks, factor in kind of how many are you going to have to hold through till the price hits your target. Strong thrust coming into, these are two of the patterns I trade, trend continuation, rounded tops, rounded bottoms. So we need a strong thrust coming into a trend continuation. We also need a strong thrust coming into a rounded top or bottom. If we move sideways and then we get, one of these little patterns, I'm probably not going to trade it. I want that strong movement coming into these patterns. So with the TC, the trend continuation, we have a strong thrust that immediately precedes the pullback and entry. So that's basically what a trend continuation is we have a strong, let's use an up example, we have a strong thrust up, we start pulling back. As soon as that pullback starts to turn back up, we're entering the long. It's basically one candle gets above a prior candle, we're entering that long trade, stop loss goes below the candles right at the bottom of the pullback, and that's our entry. But the most important part is that strong vertical, near vertical move. We want it to be quite strong. Then the pullback, that's what sets up our trade. If it's just a mediocre coming in, then we have a bit of a pullback, way less powerful of a trade, much less likely to trade it. Same with the rounded top, rounded bottom. If we have a strong trend coming in and then we get a rounded top, much better than if the price is just kind of drifting sideways. Then we get a rounded top. What's that reversing? It's probably just part of more chop. So I don't like that. Same with the rounded bottom. If we have a nice downtrend coming in, then I prefer those patterns occurring. Rounded tops, rounded bottoms can also be trend continuation patterns in the sense that we have a big uptrend, then we might have a little rounded bottom, which is our pullback, and then we start moving in the uptrend again. But again, we have a nice trend coming in, rounded bottom, trend coming out. What comes into a pattern often comes out. So if you remember one thing from this video, I would say measure wave size, and what comes into a pattern often comes out. So if it's choppy coming in, and then you see a pattern that you've learned from me or someone else, choppiness will probably come out, at least for a while. Then if you have a big move followed by a pattern, a big move is likely to come out of the pattern. Not always, but more often than not. And in trading, we're all about the probabilities. So remember, what comes into a pattern will probably come out. So that's just going to help you avoid a lot of choppy conditions, because if you see a trend continuation or a rounded top or rounded bottom and it's already been choppy coming in, just avoid it. We'll talk about some other reasons to avoid trades in a bit. So let's look at some charts. We'll go back to this slide for a second, and here I just have a blank chart up, and we're just going to go through some of these concepts that I had discussed. So the first one was measuring price waves. So I should tell you a little bit about how I trade. And so what I'm talking about with a trigger candle is, so this is a perfect example of a trend continuation pattern. We have a really strong thrust up, and then we start to pull back. And the reason this all has to align, so we have a really strong thrust, we start to pull back, and notice each one of these candles does not move above the prior candle. The first time a candle moves above the prior candle is down here. Right? They're still kind of moving down. Each candle has a lower high until this point right here. So that is my trigger. I'm waiting for the price to move above a prior candle during a pullback if I want to go long. And then the stop loss goes below the candle. I also have a little indicator down here. It just tells me how big these candles are. So this is 2.2. I know that this is forex, but if you're trading a stock, this would basically say like 2 cents. So that candle is 2 cents. And so we know that if our stop loss is going to be 2 with a bit of extra room slippage, let's say 3 or 4 cents, or in this case, probably 3 pips in the forex market. How big should our target be? We know that we need to make at least 2 to 1. So we need to move 6. We'd like the price to move 6 cents. Right up here, 6 cents. That's 2 times our risk. Now we could potentially go for more by measuring the price wave. What came into this pattern? Now remember, I'm not entering right at the bottom. I'm entering slightly above. So I like to measure my waves from the turning point. So here we were dropping. Here's the first candle that we move above. So this is where I'll measure the up wave from, where we actually got the turn. So this actually went 15 pips. So to be conservative, we could say, well, what comes into the pattern often comes out, but I don't want to, be greedy. So what if I put my target at 10 pips? Or 10 cents if you were trading a stock. Now our risk reward's up to 3.5 to 1, but we are still trading within the context of what has recently happened. We just had a nice big surge, and hopefully we get another one. Now, as this unfolds, things can change. It doesn't mean we have to change our profit target necessarily. But we can see this vertical move, once we're in the trade, is not quite what we were seeing before. So now that's new information, right? We have this nice pause, so we can measure this price wave. Okay, this one went up 6 pips before it started to pull back. Now, if we start going up, we make another trigger. The price moves above a candle high. We can start extrapolating out again. So the price starts moving up above a candle high. 6 pips is way up here. So even if this wave completes, or even if this wave repeats, this smaller one right here, right? We had this big one, but now things aren't quite the same anymore. Always looking at what is happening now. Do not get too sidetracked with, this big massive move happened, so we got to have another big massive move. That's not what this is about. This is about, in real time, what's the most recent information we have. Back here, we did have a big drop. What happens after that? Smaller waves. So we have to adapt to that and say, okay, we did have big drops, but now we're in smaller waves. And that's what we're doing over here. We did have a big wave. It was enough. It created a trade for us. It created a pullback and a nice entry. And then once we're in that trade, we can assess, okay, this is moving a little bit slower now, but is my target still reasonable? And yeah, because even if this little wave repeats, this little six pip wave or 6 cent wave, once the price starts moving up, if it goes another 6 cents, 5 cents, it's going to hit our target. So that is reasonable based on the price action we are seeing. As this continues to unfold, you continue to do this. So now we know we are in a little bit smaller waves, and it can accelerate and decelerate. So we're always just looking at the most recent thing. Actually, I'll wait, because we're going to talk about it in the next thing. I was going to talk, because this is not about prediction. We are not necessarily trying to say the last wave was 10 pips or 10 cents. This next wave has to go 10 cents or 10 pips. Again, it's just about establishing probabilities and helping us assess whether our trade is reasonable or not as more price action unfolds. So you could view this as all one big up wave, or you could look at that little pause there. And this is where you want to look at your own psychology. Would you get scared out? And be real with yourself. If you're in this trade and it just popped up and you see that little red bar, are you thinking the price is going to come all the way back and so you get out? Or are you willing to hold through it? So that'll also help you decide, which wave are you measuring. If that little pause there for 2 minutes is scary, then measure to there. So again, about 5 pips before a pause. Looks like about 6 or 7 pips on the next one before a pause, before a pullback. Next wave. So here's a nice trend continuation again. This one, it's kind of upward sloping. We didn't really get a pullback there. This one we do get the pullback. First time the price moves above a candle right there. So again, we look at the stop loss size. We can determine that even before our entry because we know how big this candle is. About 3 cents or 3 pips. So if we know that that is 3 pips, can we reasonably expect to make 6 cents or 6 pips? It's at the little bit higher end of what these moves have been recently. But then we do have a bit of leeway, right? Because as we just said, this one didn't really pull back. So we had a pretty big wave there, 12 pips. So is making 2 to 1 on this trade reasonable? I would say yes. So take both of these scenarios into account. We have pretty strong movement, but we are pausing probably every 6 pips or so on average through this uptrend. So that actually works out pretty good. We have a 3 cent or 3 pip stop loss, and we have a target at 6 cents. This is simply, again, it's not prediction. It is simply based on how the price is moving. This wave, 6 pips before it pulled back. Up to here. Well, about 7 pips. This one starts there, goes up, kind of pauses there, around 6 pips. Next wave. And again, we have a little bit of leeway because overall these pauses are resuming to the upside. So you could potentially go, like here, this one was a 15 pip up wave, so you could have said, I'm going to take 12 pips. And that still would have been reasonable based on the amount of movement we had. Here, if you take 12 pips, you know that you're probably going to have to hold through 2 of these little wiggles, saying if you're taking a trade here. Same thing continues. This one's about 9 pips. So if you went here and you said, well, we're moving quite a bit, so I'm going to put a target at 12 pips. We know that there's a pause every 6-7 pips or so on average through this uptrend. So if you're going for more than that, you're going to have to hold through a pullback. So you get out on the next wave, but you did have to hold through this junk. But you would have known that before the trade because you'd measured out the price waves. So again, this relates back to the stop loss size. We can estimate, and we want to be conservative with our estimates, how far the price can move on a wave. But we want the stop loss size to be less than half of that estimated wave size. So like I said, if we're moving up 15 pips and then we have a pullback, put your target around like 10, 12 pips, or even less. And as long as your stop loss size is half of whatever you're trying to get, you're in a good position. You're in a 2 to 1 or higher reward to risk. Here, this is a trend continuation, the strong thrust. So this is the best one, of the recent price action for sure, because there's a strong thrust. Are any of these super strong? Definitely not as strong as this. So as you start to trade more, you'll be able to pick out where's the strong thrust versus just, kind of mediocre stuff. And we'll talk about that on the next slide. So again, what comes into a pattern often comes out. Strong move in, pull back, strong move out. And again, we adapt in real time. So if all of a sudden these waves start getting a lot smaller, we adapt to that. We say, okay, now we're only moving up like 2 pips at a time. That's going to take forever to get to my target. Do I want to stay in this thing? And then maybe we start using a trailing stop loss. Or some other dynamic changes where, we had our 6 pip move up here, kind of our expected move based on how we've been moving in the past, but then something changes here, Instead of going up like it's done before and continuing for another, 6 or 7 pips or cents to the upside, it stalls out and then drops. That's a change in information. That's also a rounded top pattern. So we adapt, and something like this. So if we were in this trade and maybe we had put our target even higher up and we weren't out of this, Now the dynamic has changed. We'd probably want to move our stop loss below this low once this consolidates here. Based on all these other things, we've consolidated and popped up. So pay attention to what the price is doing. If it starts doing something different, that is noteworthy. So these are the finer points that I look for in day trading and price action in general. So we've established that what our trade setups are, what they look like, what our triggers look like, what our patterns look like. Now, I look at the candles that are occurring around the trades I'm taking, and I ask myself, are they whipsawing? So this will often come watching them in real time. If the price moves just above a prior candle and then drops all the way back to the bottom and then goes up a little bit higher and then drops all the way back to the bottom, you just have, like, inside each minute, you just have the price whipping up and down. That's a lot harder to trade in than if, the price is just kind of moving up, the candle closes, then the next candle moves up, closes, next candle moves up, closes. Be aware of what the price is doing. Because if it's just whipsawing around and moving above candles and then dropping below it and then moving above a candle and then dropping below it, the triggers I use will get stopped out in that environment. So if I'm seeing that before I have a potential trade, then I'm probably going to avoid my next trade. Just because why would I take a trade in conditions where the price is whipping up and down? So right around the trigger, I want the price with big moves, right? We want those big moves, those big thrusts coming into our trend continuations or rounded bottoms. But I'm talking about the specific candles around the entries. If it's really ragged and ugly, then I'm not going to trade because it's so easy to get stopped out. And if we go back to, let's finish this slide first. So, are the triggers working recently? So we're waiting for a very specific setup for my trend continuation. I need the strong move, the pullback. So prior to that, you get to see price action that doesn't fit your patterns. And you still get to see, even if you wouldn't have taken trades, I can look at, I know what my trigger is, and I can say, like, is the price turning and then moving aggressively? Because that's ultimately what we need for our rounded tops, rounded bottoms, trend continuations. We want that pullback, and then once the price starts to turn, we want it running hard. So is that happening recently? If it's not, that's a sign we may want to avoid. Because basically, if what we're looking for hasn't been working on the recent price action, why are we going to trade it? Wait till what you're doing is working in the market. And yeah, that's a little bit hard one for a lot of people. Is there a conviction in the price movement? If not, avoid, because drift is a killer. So drift is when the price is stuck inside prior waves. It's not making progress to the upside or downside. It's just stuck. So maybe it had a drop, and then the next rally stays within the size of that drop. And then the next wave, you're just stuck inside basically one move that happened earlier, and you just can't gain the price can't gain any traction. So it tries to move up above a prior high, and it just rolls over and goes down. And if that range is big enough, it's tradable, because you could get signals within inside that range. But a lot of times when this happens, the price action, the price wave just keep getting smaller and smaller and smaller, and people keep trading it hoping that something changes, that the big movement comes back in. But that doesn't always happen. The price will just sometimes chop around. It can chop around the entire day, and you've taken 10 losses in a row. You should never lose that many in a row. Lose like 3R max for your day, and then call it a day. Obviously, it's not a good day for you. But yeah, we don't want to assume that what's happening will change. And this goes back to even the rounded tops and rounded bottoms. Rounded tops, rounded bottoms can have smaller waves, but we needed that big thrust in. So we've had a big thrust within the last several minutes. Whereas drift is when it's just the waves just keep getting smaller and smaller and smaller, which means your reward potential drops off. If you start getting in the practice of measuring waves, it'll keep you out of a lot of chop, because you'll realize, okay, the price is only moving 2 pips or 2 cents right now. How am I supposed to make money off of that? But if it's moving 10 cents at a time, it's much easier to make money. So as it can be stuck in a range. There's nothing wrong with a range as long as the range is big enough that the waves inside it are big enough to make money off of. But drift is when you get just these tiny movements and it's just kind of, going like this, but there's just not enough profit potential, especially when we look at it from a risk-reward perspective. So I look at it as our patterns set the stage, but the context needs to be right to trade. So this goes back to what I was going to say earlier with a lot of people struggle with the chop because they're hoping something happens. And they also might see a pattern in there. So the price is choppy, but they see a rounded top or rounded bottom or maybe a little trend continuation. It was like a little pop in there followed by a pullback. And so they think, that's my strategy, so I need to trade it. That is not true. You have context and your pattern. Both have to be right in order to take a trade. So context matters just as much as the pattern, probably even more to me. If it's very choppy, we're seeing lots of whipsawing candles, the trades we usually take aren't working, and of course, we get some time to see this sometimes because we're coming into the market and something has already happened, and we get to see that. So if what we're doing hasn't been working, wait till we start to see movement that better resembles the patterns and the strategies, the price patterns that we want to see. So we don't have to take a trade simply because the pattern shows up. The context must also be right. So in terms of context, these are just, again, a little refresher. We need movement relative to the stop loss size. So whatever our stop loss size is, based on those candle triggers that I use or whatever you use, you should be able to know before the trade what your stop loss size is. Then if you measure out the price waves, you should be able to assess where a reasonable target is based on holding through no pullbacks or 1 pullback or 2 pullbacks. Again, the more pullbacks you hold through, the more likely that trend is going to reverse at some point. So that's why I'm more of hold through no pullbacks, maybe 1 pullback, because it starts getting more ambiguous the further out you try to predict. And our movement relative to the stop loss provides us with a good reward to risk. If it doesn't, if you have huge movement, but every turning point on the chart means you also have to have a huge stop loss, then it might not be worth it, even in big movement. So our risk reward always has to be, our risk reward matters, our stop loss matters, our movement matters. Those 3 things all tie in together. If it's a tough entry, the whipsawing candles, don't trade. If there's no conviction, if the price is drifting, don't trade. So let's look at some examples here. So we don't have too much. We have a bit of an example. This is before, so this is the London Open. We have some drift, what I would call drift before. So let's look over here and notice how these candles form, especially over here once we get going, or even over here. The candles are spaced out. You have very brief periods. This is a beautiful trend continuation, actually, because we pull back or drop, pull back, and then start moving to the downside again. And each one of these candles is basically making progress to the downside. So they're spread out. They're almost like stacked on top of each other, right? Whereas in drift, you tend to get candles stacked beside each other. So, these candles, there's no progress being made. They're just stacked side by side. And even when the price is moving a little bit, so we start to get a little more momentum and they start to get a little more spread out here. But throughout this area, very little progress is made. You might have one candle move to the upside and then they just start stacking beside each other again. If that's happening, I'm likely not going to trade because I'm not going to focus on this one tiny candle that happened to make some progress and ignore everything else that was just stacked up beside each other. Because then all of a sudden you're saying, I think I can predict when that one little pop is going to occur in a sea of sideways movement. I'm not that good. I can't. I've been doing this for 17 years, so I don't think most other people could either. So assume that this is just not good trading environment for you if it's just stacked up side by side. Not being able to gain any traction, that's another side of drift. So we can see we're moving sideways, the price tries to drop below these lows and it just starts curling up. So again, we would already not be trading this because of candles stacked up side by side. We would also not be trading this because it can't make any progress out of this area. Even up here, it tries to move out, goes maybe a few pips, and then it comes right back in. That's very different movement than over here, where we're easily able to make, if we're just comparing recent highs and lows, like this isn't able to make a whole lot of progress before basically reversing the other way. That's quite different than what we have over here, where we can clearly make easy progress, connecting highs and lows, and it's moving with conviction, I call it, where our lows and highs are separated, we have trends going on, and overall there's better movement, and then it just continues to improve. As I said, we're not predicting that this is going to last forever, these price waves. So again, we're in that kind of 6 pip price wave area. That one's about 7 pips. And then we get the acceleration. And then once that happens, we think, okay, maybe we're in bigger movement environment. So we go off that. We put our targets out a little bit bigger than maybe we were before, or can go for a little bit more reward to risk. And then if that changes and we go back to smaller waves, then we adapt to that and our targets shrink in again. And that means that our stop loss sizes need to be smaller again in order to trade it. Let's go back to our slides. So the final points that I would make are more general in nature. And that is that you are trading your own game, not the markets. You get to decide when you trade and when you don't. And the market's going to try to lure you in. It's going to give you big price waves followed by really big stop losses. And if you're not thinking about the price action in this way, you're going to get lured in. You're going to take a big stop loss trade. And even though the movement looked pretty good, you're going to have a shitty risk reward because the price isn't moving enough to justify taking that huge stop loss. When you multiply it by 2 to get a 2-to-1 reward to risk, it's just not going to make sense. So we get to decide when we trade, and the market's also going to try to lure us in during those grindy, choppy movements. It's going to show us patterns inside of chop and drift, but it is not just the pattern that matters, it is the context. It's going to try to lure us in when the price is whipsawing around. Market makers love that because, you're getting in at the top of a candle and then it just goes right back to the bottom. You try to get in again, the same thing happens. You just get whipsawed out a few times and you've, lost a bunch of money and someone else has made a bunch of money. That's their game. We get to wait for when conditions are good. So if it's whipsaw, don't trade. If what we usually trade doesn't seem to really be working, don't trade. Wait till it does. Everything must align. So a strategy or signal means all of it, not just the pattern. And so a lot of people read about a strategy, and they've also read that in a book, like you should be taking every strategy signal you get because you don't know which ones are going to be the winners. And while there is some truth to that, it's taken out of context in the sense that you also need context. So just a simple, even like a moving average strategy or something, you should have context for when that works and when it doesn't. And you can really improve your results by looking at when does the win rate tend to be higher with a strategy, what kind of price movements are going on, when does it tend to lose, what should I be avoiding with this strategy, and adding in that context element will greatly enhance your trading. So 1 to 3 trades a day, and I trade for anywhere between half an hour to up to about 2 hours. 1 to 3 trades where everything aligns is way better than 5 to 10 mediocre trades. Most likely you're going to end up losing money or just barely breaking even if you're in this kind of, well, I'll trade any pattern that comes along, pattern in quotes, but you're not taking the context into account. 1 to 3 trades a day with a $2 reward to risk is you're making 2 to 4 R a day. That's like 2 to 4% just avoiding all the other junk. The other junk is just going to erode that. So our job as traders, as day traders, as price action traders, is to recognize our context, our pattern, and our trigger. And basically these all set up a minimum reward to risk that we need. Before that trade even happens, we know we can reasonably make 2R or more. And we're trying to find this all in a sea of data. So that's the market's game. They're throwing us a sea of data, someone else is hoping to trip us up. But our game is simply to focus on this. That is it. It does not matter what happens outside of that. Once you have a strategy you know works, you've practiced it, that is your entire trading world. That is all you focus on. And it doesn't matter what happens outside that. The other day I saw the biggest candle I've ever seen on a CPI number. It went 107 pips. And that's a monster move on a 1 minute candle. So, but my strategy didn't have a entry point for that candle because it's a single candle. It's a one-time sort of event. My strategies all require multiple candles. So I didn't get in on it. But I didn't miss out, or I wasn't worried about it because it didn't fit one of my patterns. So you want to integrate that into your belief so that you don't have fear of missing out. If every move you look at you think you should have been in on, you will never be a good trader because you'll never be able to be good at trading every price move. You're only able to get good at trading certain price moves. So to get rid of FOMO, you will need to integrate and truly believe this, that your only job is to recognize your pattern and nothing, your pattern and your context, your reward to risk, and nothing else outside of that matters. And there's an article on it, Tactics on Improving Self-Control and Discipline While Trading, and it's under, if you go to Trading Improvement, it's in that section. I think it's on like the number of pages will change, or you can just search in the box here, Tactics, and it should come up. And what this talks about, it talks about integrating beliefs through identity, and identity is a really good way to change our beliefs, and basically we don't have to use willpower if we can change our beliefs and our identity about how we associate. So I just view myself as a trader who doesn't care about moves that occur outside of my strategy. So like I said, this move here, that was a nice up move, but it doesn't really fit one of my strategies. I didn't really get a pullback there. 99% of the time, I'm not going to be involved in that move. And that's okay, because I captured profit there, and at the end of the day, I get to walk away with some money. I'm not going to potentially waste what I have in order to chase moves that because if you start chasing price right when it's at highs all the time without a pullback, you're going to lose a lot of money, right? That's like going short right there, and the price is going to reverse on you a lot. So it doesn't fit within my strategy, so I'm okay to let it go. Be okay with what your strategies present and walking away with your 2 to 4 hour a day. That's how you make a living, and you can make a phenomenal living. You're going for, I like to think of it as you're going for singles and doubles, with a baseball analogy. You're going for singles and doubles a lot, maybe the odd triple. You're not going to get home runs on any of your single trades, but what that results in is world massive home run performance overall, because basically you're singling and doubling other teams to death, and you're just scoring runs, but you're doing it, with these singles, doubles, 1R, 2R, 3R at a time, and that's how you build up your trading account, and that is how I view the price action trading. So hopefully that sums it up. I will post a copy of this just so you can copy and paste it and have some of these next to your desk if you need them. And until next time, happy trading.